In this week's episode of the Stock Scores Market Minutes, I'm going to teach you how to know when to buy fear. I'll then do my regular weekly market analysis, give you a sense of whether there is more of a correction coming in the stock market. We'll do a market scan in search of opportunities and look at the trade of the week on LCI. So it seems fitting that right now, with all of the volatility in the market, we should understand when to buy fear. When is that the right time to jump into a stock that has been showing a lot of weakness? Fear in the hearts of investors will cause prices to be pushed to irrationally low levels, and that presents an opportunity. Now, we can see fear when we look at a chart by the steep downward trend that has run far below the downward trend line. In other words, we tend to see this parabolic move to the downside as people panic and sell irrationally. Now, when this happens, what we want to watch for is a break of that steep downward trend line. The quality of these trend line breaks is higher if there is a rising bottom on the chart first. So let's take a look at some examples where we saw some pretty strong selling in an individual stock. So here we have a stock, there's the downward trend line, and we were quite far below it, and then we broke the downward trend line there. We built a rising bottom here and then broke from a rising bottom, and the stock continued higher from that point. Another example, this is Eldorado Gold. You can see that we have one trend line kind of cutting across the tops like that. That trend line was broken. The stock had fallen away from the trend line, come back up to it, pause, and then broke the trend line. And then we had a break from a rising bottom here, which is even better signal to enter that stock, which had been very weak for a long time. And of course, ultimately it went into a very strong trend, much like many other gold stocks. And if we look at one more example, this is a stock that has not yet broken its downward trend line, but we do have that fear-based selling. So this is Canopy Gold, or Canopy Growth, sorry, not gold, I've got gold in my mind here. And if we can break the very steep downward trend line, that'll be step one. We then want to see a rising bottom form, and then ultimately we want to get through that longer term downward trend line. So a lot of the cannabis stocks have been pretty weak of late, and if they can manage to break their downward trend lines, then maybe they're worth considering again. All right, let's get into this week's market analysis, starting us off with the US markets. And you can see here we have a chart of the S&P 500, sideways trend. For the most part, we're oscillating between support and resistance, quite a wide band. You can see some big moves up and down. You know, compare those big moves with the much more normalized trading. You can see that there's a lot of volatility in the market, and that volatility relates to uncertainty about primarily China-US trade. The market rallied into resistance and got stuck at resistance on Friday, and I expect that we'll probably stay stuck in this trading range until there is some catalyst to break us out, either some very good news on trade, which would break to the upside and bring us back to the highs from July, or if we get down to the bottom and we have some really bad news, we might break down and go more into a corrective phase again. So those are the boundaries you want to watch for. Do we break up and hold above 294, or do we break down and hold below 282? Looking at the long-term chart, I was a little nervous last week because, of course, that upward trend line was broken. We've bounced back, and we're right at that upward trend line again. So I'm going to raise my rating to neutral from bearish, but I still think you should be fairly cautious long-term on the US stock market. At the small cap, or on the small cap stocks, you know, we had this breakdown here at the start of August, and we've been sort of grinding our way lower. We don't have as much profit to give up on the small caps. You can see that they really haven't trended higher. So generally speaking, the small caps is a pretty dead place to be. If we can get up through this resistance level, then I'll get a little bit more excited about it. But for now, I think generally speaking, you want to be very cautious with the small cap stocks in the US. Moving along to the Canadian markets, and you can see similar with the S&P 500, we're stuck in this sideways range, quite a volatile range. We're at the top of the range. If we can break out, then we'll head up into this resistance zone. Not a lot of upside, to be frank, but still a relatively stable market in the last couple of days of the week, and that is a promising sign, but I wouldn't get too excited until we can break out of the trading range. Here's the longer term chart, and again, very much range bound. You see here we're stuck in that sideways range. We tend to bounce around inside here. And so really you want to buy when there's weakness at the bottom, and you want to be more of a seller at the top of that range because the market has not yet found the reason to break back into an upward trend. This is a good example, though, of how fear-based selling was prevalent in the Canadian market. You can see that the trend went parabolic to the downside. We broke the downward trend line late in December and then went for a very nice rally. So keeping with that theme of this week's topic. Looking at the TSX Venture, you can see we remain in a downward trend. We had broken this downward trend line. That gave me a little bit of cause for optimism, but we never managed to break out from the rising bottom. That did not happen. And so now we're stuck in trying to base some more. And I think it's got work to do, but at least it's stopped going down. On to the currencies. US dollar had another strong week. And what's significant here is we've broken out through that long-term resistance that I've talked about going all the way back to January 2017. We've closed above that level now. We paused there for 4 weeks and we've broken through. So the upward trend in the US dollar should continue. That's not going to be too helpful for the Canadian dollar, and you can see that the weakness is still there in the Canadian dollar. Now we are coming into a zone of support because we've got that upward trend line, so expect that we'll find that support, bounce off of it, and maybe start to build off of that downward trend line break that happened a few months ago. Still work to do on the Canadian dollar, but at least it stopped going down and is relatively stable. On to the interest rate chart. Of course, we always look at the bond market to get a proxy for interest rates. And this is a market that's gone parabolic to the upside, which means it's risky for a pullback. Managed to hang in quite nicely this past week. Still no sign of a breakdown, but I would not want to be initiating positions in bonds right now. I think that the bond market is overextended and likely to pull back soon. But until there's a breakdown, I wouldn't get too worried about it. Commodities. Well, here we have gold. Hit a new high, new local high anyway this week, but closed below its open. That's a bit of a bearish sign. I think maybe we'll see a little bit of a pullback. It really depends on what happens with equities. I think what we've been seeing is that when there is concern about China-US trade, money comes out of stocks and looks for safe havens, and the gold and silver market have been those safe havens. They have gone up very nicely the last few months. I would not want to initiate new positions, but there is no reason to sell existing positions yet either because we remain in that upward trend. And the oil chart also trying to stabilize, but still stuck in that pennant pattern that I talk about week after week. We need to either break out of the top side of that pennant, which would be a sign that the market's going to go higher for oil, or to the downside. I think, again, revolves a lot around China-US trade. Why? The market believes that the economy globally will go into a recession if this trade war continues. And a global recession would mean less consumption of oil, which means oil prices go down. That's kind of the logic that the market is applying right now. And so if we get some positive resolution to China-US trade, or at least some hope, we may see oil finally break out of this pennant. But if there is a backward move in China-US trade relations, then we could see a breakdown and a break down to this support level. So right now we're in the pointy tip of the pennant. Just wait for it to break one way or the other to tell you what to do next. And finally, the fear chart. We always look at the VXX to get a sense of how much investors are buying insurance in the options market based on S&P 500 futures. Sorry, not the options market, the futures market. And the implied volatility that comes from that futures market on the short-term futures for the S&P 500 is what the VXX is based on. When people are willing to pay more for that insurance, this goes up. And that's why it's called the fear index, because people want to buy some safety, fearing that there may be a correction. So we can see that the chart here has broken this downward trend. It's in the sideways range, but it really hasn't gotten to panic mode. For panic mode, we'd have to get a breakout to the upside. So for now, it's just a moderate bit of fear, but still something to keep an eye on. So my ratings then, neutral on US stocks and Canadian stocks. I remain bullish on gold, but again, not to the point that I would want to be buying gold stocks for the first time, more to hold. Oil, neutral on both time frames. Stocks continue to trade in a wide and volatile sideways range, and that's driven by headlines on trade. Investors should stick with stocks if their longer term outlook is in place, but as long as that support at the upward trend line is held. If that upward trend line is broken, then it's time to be cautious. Gold remains in an upward trend and oil is stabilizing. Fear is elevated, but there is no panic. All right, let's jump over to the Stock Scores Market Scan tool and see if we can find some opportunities. This week I thought I would run the action break scan. This scan looks for stocks making abnormal moves with abnormal volume from downward trends. So it's sort of that break of the downward trend that shows that fear is reversing. And so we'll take a look at Sept to begin. And this stock has broken this downward trend line from a rising bottom, a little bit of a spike in price there with some accompanying strength in volume. It's not super liquid, only traded 638 times on Friday, but it does look to me like it wants to head back up towards the 50-cent mark, and therefore is something to consider if you are a fairly nimble trader on the Canadian market. CNAT doesn't have anything I like. This is a stock that I found yesterday, and I actually featured it in my daily newsletter. You can see here the break from a rising bottom after breaking the downward trend line back here. This is what I call a bottom fishing pattern. It worked out quite nicely today after that buy signal yesterday, up 19% so far, and I do think it likely continues. Doesn't really have major resistance until we get up to 180. A little bit of a chase now because this is now the second day up in a row. You may want to wait for a little bit of a pullback, but the chart is a pretty solid one. Community Health, let's blow this one up. So here's the downward trend line. And sorry, it's not letting me draw it, but you can see the downward trend line was broken today. Not really from a rising bottom, so it's not quite as high a quality. We're also hitting some resistance here. If I was going to give this a rating, I'd give it a 6 out of 10. It's good, but it's not great. Moving along, that one's not really breaking the downward trend line, nor is that, nor is that. It's really just rising up to the downward trend line. This one's basically also rising up to the downward trend line from heavily oversold, so I don't think it's an ideal trade just yet. And I think that's all that we got today. End of the summer, last trading day of the summer, so it's a little bit slow. We'll get back to normal conditions next week. All right, let's take a look at the day trade of the week. This again is just an educational thing. I like to show stocks that trigger my day trade rules, sometimes long, sometimes short. Today's pickup here was right there at the pink dot. You can see with my mouse moving over, that is a break from an ascending triangle with an action candle. I have a service called Active Live where it identifies these stocks in real time, and you can learn more about Active Live if you go to the Stock Scores website under Stock Analysis, I believe, on the right hand side of the menu, and you can learn all about how to use Active Live. So the economics of this trade are really good. If you were willing to take $100 worth of risk, it was a 830 share position. Now these are all numbers that are calculated in real time for Active Live subscribers as they watch my screen. That meant just under $7,700 of capital, but again, you can margin this 3 to 1. And so that means the actual capital required was $2,565. It made a return of 9 RR, which is 9 times risk-reward ratio. So that's a $900 gain on $2,565 of capital. That's a 35% return on a stock that was held for really less than a day. So a real stellar day trade on LCI today. All right, well, that has been this Stock Scores Market Minutes for September 2nd, 2019. It's back to school for the kids this week. I hope that you have a great week in the market. Click on the like button, subscribe to the channel, and most importantly, trade well.